This is the Chapter 3 in-class problem. So we've got an annual accounting period that ends on December 31st, which means we are doing adjusting journal entries for the entire year. They give us all of these accounts, and then we get A, B, C, D, E, F of the things we should look at to see if there's an adjusting journal entry needed, and if so, what is it? That is requirement 1. Requirement 2 tells us go back to C and E and record the first regular journal entry of the new year. Okay, so I kind of spread it out a little bit so I could write the journal entries here on the same sheet. We'll start with A. Office supplies started off the year with a $4,000 balance. During the year, we purchased more supplies, $13,400, and added it to the office supplies account. At the end of the year, the inventory of supplies available, $2,554. So we need to write the journal entry that shows, the adjusting journal entry that shows how much we used up in supplies. We're looking for used up. The adjusting journal entry is how much we used up in supplies. So that journal entry is going to be supplies, a debit to supplies expense, and a credit to supplies, or office supplies in this case, same thing. Supplies expense is an expense account that we're increasing. We do that with a debit. And supplies is an asset account that we're decreasing, so we do that with a credit. Let's work the numbers here. We started with $4,000 at the beginning of the year. We added another $13,400 throughout the year. So that means we had $17,400? $17,400 of supplies in our supply closet during the year. At the end of the year, we go in there and we count up, and there's $2,554. So the difference between all of the supplies we had and now at the end of the year, the supplies we have remaining, the difference between those two numbers would be the supplies that we used up during the year. So I'm going to subtract out $2,554, and that gives me, what is that? 17,400 minus 2,554 is 14,846. So my journal entry is a debit to supplies expense for 14,846 and a credit to supplies 14,846. That's my adjusting journal entry at the end of the year. B, prepaid insurance had a $20,000 debit balance at the end of the year before making any adjusting journal entries. An analysis of our prepaid insurance shows that we have $12,880 of unexpired. Unexpired. Remember, I warned that you need to look to see what they're giving you. Are they giving you expired or unexpired? Are they giving you the amount that was used up, or are they giving you the amount that is unused and remains at the end? Here they're giving us unexpired. So we need to calculate the expired amount. $12,880 of unexpired insurance remains at the end of the year. So we started with $20,000. And at the end of the year, we still have $12,880 of prepaid insurance. So we need to find the difference. So we can see there we go. We need to find the difference so we can see what we've used up, what has expired. 20,000 minus 12,880, 7120. So our journal entry is a debit to insurance expense and a credit to prepaid insurance. Insurance expense is our expense account that we are increasing. We do that with a debit. Prepaid insurance is an asset account that we are decreasing. We do that with a credit. And we just calculated the amount, 7120. That is the prepaid insurance that we have used up. So we're going to expense it. Next, we have 15 employees who earn a total of $19.60 in salaries every day. They're paid every Monday for their 5-day work week ending on the previous Friday. So they get paid once a week on Mondays, and it is for 5 days of $19.60 each. So somewhere around $10,000 is going to be their total pay. Let's see. December 31st, that's today. That's the day we're doing these adjusting journal entries. December 31st is a Tuesday. And everybody worked the Monday and the Tuesday of this week. So we know that on Monday we paid them for last week and we expensed. When we pay them, we expense. We paid them and we expensed those salaries expense. Today is December 31st. We haven't recorded another expense. We'll do that next Monday. So today we need to record the salaries that happened on yesterday, this first Monday, and today, Tuesday. So we need 2 days of salaries. 1960 a day times 2 is 3920. 3920 is the amount. Let's see. 1960 times 2 is 3920. That's the amount of salary that we need to record for the 2 days. So our journal entry is going to be a debit to salary expense for $39.20 and a credit to salaries payable. This is an expense that's happened, but we haven't paid it yet. We're going to pay it on next payday in next year. So right now I'm going to record it as salaries payable. Salaries payable is a liability account that we are increasing. That's why this is a credit for $39.60. And salary expense is an expense that we are increasing. That's why it's a debit. I'm going to jump over to requirement 2. Requirement 2 said for C and E, record the first regular journal entry of the new year. So for C, what they're talking about is record what payday on the next Monday looks like. So right now we're on Tuesday, December 31st. We just made an adjusting journal entry to record the last days of salary of this fiscal year. And so on Monday, we're going to record the paychecks paying our employees for yesterday and today and tomorrow, Thursday, and Friday. So they'll get that paycheck on Monday, and requirement 2 wants us to record that. So here's what that looks like. Oop. I left a little space in between there on purpose. A normal payday is going to be a debit to salary expense and a credit to cash. And this one, this very first paycheck of the new year is going to look similar to that, but not exactly the same. So the cash amount's going to be the same. They're still getting paid for 5 days, and I think the problem even says something like New Year's Day is a paid holiday, January 1st is a paid holiday, so they're still getting paid for what would that be, Wednesday, January 1st. So they worked 5 days in this pay period, $19.60 a day. $9,800 for the 5-day work week. So we're going to pay them cash. $9,800. Cash is an asset account. We are decreasing it. Cash is a credit. On a normal payday, we would record a debit to salary expense for the same $9,800. But this is not a normal one. This one, they only worked Wednesday, Thursday, and Friday in the new year. They worked Monday and Tuesday in the prior year, and we already recorded that on December 31st. So we are going to get rid of that salaries payable account that we created on December 31st. We're going to wipe out the entire $39.60 with a debit to salaries payable. That's a liability account that we are decreasing, so we're going to debit it for the whole $39.60. So we're going to wipe out everything in that account. That represents Monday and Tuesday of the work week. Now we have to pay them for January 1st, 2nd, and 3rd, which is Wednesday, Thursday, and Friday of the new pay period. So it is 3 days at $19.60 a day, $58.80. $58.80. Oops. $58.80 is the salary expense for. I hope something doesn't look right. Is the salary expense for the new year. So I should add those numbers. When I add those numbers together, they should come out to 9,800, and it's looking like they're not going to. So 58.80 plus 39.60 is not 9,800. So I made a mistake somewhere. My journal entry is not in balance. 39. Oh, there it is. Not 39.60. 39.20. 2 days, 1960 times 2 days is 39.20, not 39.60. So let me double check that now. 58.80 plus 39.20 is $9,800. So my journal entry is in balance. And that is requirement 2. What does the first payday look like? How do we record the regular journal entry for the first payday of the new year? The second payday and the third and the fourth are all going to look the same. A debit to salary expense for $9,800 and a credit to cash for $9,800. It's just this first one that looks a little different because we have to debit to get rid of the old salaries payable, and our expense is going to be a little bit smaller because some of the expense happened last year and some of the expense happens this year. Next is D. We bought a building at the beginning of the year. It costs $960,000 and is expected to have a $45,000 salvage value at the end of its predicted useful life of 30 years. It tells us all that stuff, and then it tells us annual depreciation is $30.50. I'm going to write it out anyway. Make sure you know how to do this. Calculating straight line depreciation is the cost of the asset minus the salvage value. The textbook calls that net cost, I think. divided by the expected useful life. So 960,000 minus 45,000 is $915,000. That's what we're depreciating, spread out over 30 years. So $30,050. Sorry, $30,500 every year. So make sure that we know the amount of time that we are recording here for this adjusting journal entry. On some of those problems that we saw, we were only doing a month, so we'd have to divide this by 12 to get a month's worth of depreciation. But here, we're doing the adjusting journal entries for the entire year. So that's our number right there. And for depreciation, the journal entry is a debit to depreciation expense. That's an expense account that we are increasing. We do that with a debit. And a credit to accumulated depreciation. That is a contra asset account. We are increasing it. Normally an asset account gets increased with a debit. This is a contra asset account, so it gets increased with a credit. That's why this is a credit. And the amount we've already calculated, $3,500. I keep saying 3050. $3,500. $30,500. So there's our journal entry for D. Now let's look at E. The company is not large enough to occupy the building it owns. It rented space to a tenant at $3,000 a month starting on November 1st. The rent was paid on time on November 1st, and the amount received was credited to rent revenue. So that journal entry is not important here, but that journal entry was a debit to cash because we received the cash of $3,000, a debit to cash for $3,000, and a credit to rental revenue. But that's not important. That's not what they're asking us. However, the tenant has not paid December rent. The company has worked out an agreement who promised to pay both December and January in full on January 15th. So we're sitting here at December 31st, and we haven't received December rent yet, but we have earned it. So we want to record December's rental revenue as an adjusting journal entry at the end of this month, the end of the accounting period here. So this is going to be, a credit to rent revenue. In the amount of $3,000. We've earned that $3,000. We just haven't received it. So the debit is going to be to accounts receivable. For that same $3,000. Our tenant owes us this $3,000 payment. So we're going to debit accounts receivable. That's an asset account. We're increasing it. That's why it's a debit. And we're going to credit rent revenue. That's a revenue account that we are increasing. That's why that is a credit. And also requirement 2 tells us record the first regular journal entry for this in for E. So that means that on January 15th, this tenant paid both December and January rent in full. So that is cash in. We're going to record, I keep doing that. We're going to record cash. Yep, let me change the color. We're going to record cash. Cash in, cash is an asset account. It's increasing, so we're going to debit it. For 2 months, we're charging them $3,000 a month. So for 2 months, that's $6,000. And we're going to record rent revenue for January. Rent revenue is a revenue account that we are increasing. We increase revenue accounts with credits. And finally, we're going to get rid of the accounts receivable that we created back here. We're going to get rid of this accounts receivable right there by crediting it. It is an asset account, and we are reducing it. We're getting rid of it. And we're getting rid of it completely. So the full $3,000. So they paid us $6,000. Half of that was for January rent, so we're going to record rent revenue. And the other half was for December rent. We already recorded December rent revenue on last year's income statement, on last year's financial statements. So we don't want to record another $3,000 of rent revenue. Instead, we want to wipe out that accounts receivable account that we created with the adjusting journal entry at the end of December. And our last one, on November 1st, the company rented space to another tenant for $2,800 a month. The tenant paid 5 months rent in advance on that date. The payment was recorded with a credit to unearned revenue. So they're not asking us to write it up. I won't write it up, I'll just talk it out. Back on November 1st, we recorded a debit to cash because they paid us, what did they pay us? $2,800 times 5. They paid us $14,000 in cash on November 1st. That's 5 months of rent at $2,800 a month. They gave us $14,000 cash, so we record that as a debit to cash, $14,000, and a credit to unearned rent revenue or unearned revenue. That's a liability account showing that we owe them rent or we owe them their money back, but we owe them something. Okay, that's what happened on November 1st. That's not what the question is asking. The question is asking, what's our adjusting journal entry on December 31st? So we have now earned November rent and December rent. So we're going to record 2 months of rent revenue. And let's see, 2 months is 2,800 times 2. 2 months of rental revenue is $5,600. So rent revenue, I'm going to credit it for $5,600. That is a revenue account that we are increasing. That's why I credited it. And I am going to debit the unearned revenue account. Unearned revenue account is a liability. I am decreasing that liability. That's why I'm debiting it. We have earned some of that liability. So we're going to move it out of a liability. We no longer owe it. And we're going to move it over to revenue. And again, $5,600. So now there should be 3 months left in that unearned revenue account that we will do an adjusting journal entry for next year. And that's the whole problem.